What's going on? This is David W. Williams, the founder of the highest paid part-time job in the world, also known as Diamond Dave on social media. If you're looking to stop selling your most valuable asset, which is your time, to your employer, and getting something back that is a lot less valuable, which is income from that particular employer, you're tired of some of the controls they're putting on you, right? But you necessarily don't really want to lose some of the income from not working for that same person. Reach out to me about the highest paid part-time job in the world, and I'm 100% confident that we have a solution that'll work for you. So the question in this particular video is that kind of how do we leverage momentum as options traders, or do we desire momentum in the options market? What's going on, John? And we have to understand that momentum is something very powerful, right? Or some people also like to call volatility, because what it does is it creates massive price movement. So whether the price movement is going to be up or the price movement is going to be down, it creates a lot of massive price movement. And if you can be positioned before the particular momentum takes place, right, you'll start to see the premiums on those contracts start to really go up. What's going on, Katrina? Everybody do me a favor, Katrina. I appreciate it. John, if you could do me a favor, could you like the video? As soon as you come in, if you could do me a big favor and like the video, it really help me out from an algorithm standpoint. So what you're seeing is that as the momentum starts to move in a particular direction, what it does is it starts to really ramp up the premiums on the contract. So what we're going to do is that we're going to talk about Tesla as a case study, right? So over the past, let's say week and a half, there's been a massive amount of momentum in the market for Tesla shares, right? So Tesla had their, I want to say Thursday, they put out their delivery date. And a lot of people anticipated their delivery date being positive. So what we saw happen was, as we got closer to Thursday, there started being a lot of positive momentum behind Tesla, right? So then the delivery date came out, the delivery numbers came out, and they exceeded what people had estimated. I think they estimated around 80,000. Tesla delivered around 90 to 95,000. So what did that do? It created more momentum on those particular shares. So now we had the market was closed Friday, right? So the market closed positive up Thursday, right? Closed positive up Thursday. We go into Monday. We wake up and Tesla is already $60 to $70, right? Higher than its close in the pre-market. So what are we starting to see now? More momentum. Market opens today. We see a massive amount of momentum for Tesla. I think Tesla might have closed, I don't know, around 1,300. I think it was 1,400 in the aftermarket when I last looked, probably about an hour ago. Now, what is that momentum doing? Normally what I teach with options, and I teach this for a reason, I teach people to buy their particular strike price as close to the share price as possible. Why? Because you have to believe that if you buy way out, there has to be something outside of the norm that's going to take that momentum and push it in that particular direction. So let me give you an example. Let's say we're looking at company XYZ, and they're going to release earnings in 2 weeks, and their current share price is $100, right? What I teach people to do is buy as close to that $100 share price. Buy your strike price as close to that $100 share price as possible. So any momentum moving positive towards that 100, you could take advantage of, because if you buy way out, right? Let's say it's 100, you buy 130. Something miraculous has to happen for it to start moving towards that 130 with a lot of momentum to make the premiums on those particular contracts go up. And what happens in the options market is a lot of people nickel and dime themselves to death buying way out of the money. What do I mean by that? We'll take it again. Company XYZ, share price is $100. We're buying in anticipation of earnings, let's say 3 weeks out. The $100 contracts we can't afford. We can't afford the 105s. We can't afford the 110s. We can't afford the 120s. We start looking at maybe the 130s, 135s, and 140s. Those are relatively inexpensive based on our budget. So we buy those, right? As we start moving closer to earnings, the share price goes towards, let's say, 100, and it maybe starts to hit around 110, 115, and we start getting a lot of emotional resistance in the market, which means that the market is not willing to pay over 115 for these particular shares, right? The problem is we bought in at 120, 125, if I remember what I just said. Our premiums really don't go up that much. So at best, we might break even on the contract if we sell before earnings. If we hold after earnings, then we got to start worrying about theta decay, decaying the contract. Because I don't want my students to get in that position, I teach them, try to buy as close. Appreciate it, Demetrius. I got a lot of them gems from you. You know, I try to pick up what game I can pick up from people, and I try to implement it as soon as possible. That's something I learned playing sports. So if we buy as close to strike as possible, any kind of premium increase, right, allows us to get in profit as close as possible. If we buy way out, what can happen a lot of times is you nickel and dime yourself to death. The market makers always price those contracts way out because it's an easy way for them to make money on cover calls, because essentially, if you control enough shares, you can build your own casino. And we're going to go into that particular topic later. I may build out a whole class on that because that's really what the game is about. It's really about building your own casino where you make money on probability and percentages. What we're looking at with Tesla is this. There's so much momentum in that market. You had the opportunity. Now it's different because essentially everybody's figured out what's going on. But there's so much momentum in that market over the past week. You can literally buy $300 to $400 outside of strike, outside of the money. You could buy $300, $400 outside of the current share price. And because of the way Tesla was moving, right? The premium on the particular contracts was going up. So I bought, and I showed this on Facebook, I bought, I think, a 1700 when it was 1200. It started moving towards 1500. What happened? The value of that particular 1700 contract went up. No, I'm sorry. I bought 1500 when it was 12. Started moving past 12. The value of that 1500 went up. I sold that within a 24-hour period because I had to take advantage of that momentum. Then I went back in before market closed. I bought a 1700 when the share value was around 1250, maybe getting close to 1300, right? And what happened today? Because we saw momentum moving in this particular direction, those 1700s opened at profit. So I'm 250, 300 outside of the money. I'm 250, 300 above the current strike price. But because of momentum, right, the premium on those particular contracts increased. And as we saw Tesla continue to move up, it went up pretty much all day, had a little bit of a dip, and it kept moving up. Tesla now is around 400. That contract that I sold, that I bought for 183, it closed the day around $1,800. That's all off momentum. It's not off any fundamentals. It's not off the balance sheet. It's not off of an earnings call. It's not off of any real relevant news. It's just a lot of momentum in that market. And that momentum is creating a large amount of volatility, which is making people price those options at a very, very high rate. So what we talk about in the highest paid part-time job in the world, I tell people, once we learn about volatility, I tell people, you can trade volatility. There's people that have scanners and they have particular software and they find particular shares or markets around shares that have a massive amount of volatility where it's going up or going down. And they just trade volatility. They don't care about fundamentals. They don't care about the balance sheet. They don't care about profit earnings. They don't care about any of that. They just try to find a very volatile space and they trade that volatility. This is one of those situations in which we had the ability to do that without any of that sophisticated software because I don't own any of that. But I understand that there's so much euphoria and confidence around this market for Tesla. It's creating a massive amount of momentum around the stock. So in this situation, I went outside of my principles and I didn't buy as close to the money as possible. However, you got to understand something. I've been trading options for over a year. This is a particular type of play for a sophisticated trader. It's not a play for a novice. Because if you don't understand what you're doing and you try to milk this cow many times, you may end up on the wrong side of the play. So that's why when I woke up this morning, I got out as soon as possible. I could have made a lot more money sitting in the play. But I can't do that with this kind of play. It's a momentum play and I'm not controlling the momentum. So what does that mean? I got to get out as soon as possible. That's what works for me. It might not work that way for you. So in this situation, I'm not buying as close to strike as possible. I'm buying out at a price point in which I think I can afford. But let me tell you something. I had already observed Tesla and this kind of behavior before. So I knew that Tesla would create a lot of momentum going up. And if you had contracts on calls that were $200 and $300 out of the money, you would still get a lot of premium increase and then you could sell them, right, and make a lot of money because other people believe that those particular that price point is going to match that. There's somebody that bought that contract for me and they probably think Tesla's going to hit $1,700 by the 17th. A lot of people today think Tesla's going to hit $1,500 by the end of the week. It may not, but they believe that. So if Tesla hits $1,500 by Friday, that $1,800 contract might turn into a $3,500 contract because you still got another 5 days left before the contract expires. So this is a pure momentum play. And you got to understand, like, this exists in the market. It's a way to make a lot of money relatively quickly, but you got to be savvy. You cannot be a novice. You can't not come in with a plan. I came in with a plan of when I was going to buy, and I came in a plan when I was going to sell, and I didn't get caught watching the price. So did a lot of people make more money than me after the fact? Yes, that's cool. But what did I do? I came in with a plan of when I was going to buy. I came in a plan of when I was going to sell. And I got in and got out, made my money, and kept it moving. So there's nothing wrong with these type of plays. But like I say before, they're not for rookies. They're not for people that are novices. If you haven't made successful plays yet, buying as close, right? Buying your strike price as close to in the money as possible. And what I call in the money is what I mean by that is that your strike price matches the share price. A lot of people do $5 above the share price and $5 below. To me, in the money, for me personally, is that your strike price matches the share price. And you want to get as close to that as possible because any kind of movement, positive on a call, a negative on a put, is going to start to really ramp up, right, the value of your contract. So if you know somebody that can get value from this, share it out. Appreciate you liking the video. If you know anybody that got any questions about the highest paid part-time job in the world, we moved into the automated course. We're going to put the one-on-one at a higher level. We have these kind of conversations. We really start to break this stuff down. This is David W. Williams, also known as Diamond Dave. I'll talk to you later.